Here's a number that should bother you. A strategy that wins 55% of the time with equal-sized wins and losses has a positive edge on paper. And you can still bleed your account down to nothing, not because the strategy is broken. Because of one input you probably never calculated, the exact percentage of your account you risk on each trade. This is educational commentary, not personalized financial advice. But by the end, you'll know the threshold that quietly turns a winning system into a slow-motion loss. Most retail traders obsess over entries. Better signals, cleaner setups, the perfect indicator. Almost nobody sits down and does the position sizing math. And that's backwards. Your win rate and your reward to risk decide whether you have an edge. Your bet size decides whether you get to keep it. Two traders can run the identical strategy, take the identical trades, and one compounds steadily while the other slowly grinds to zero. The only difference is how much of the account rides on each trade. Let's define the edge precisely. You win 55% of the time. When you win, you make 1 unit. When you lose 1 unit. Your expectancy per trade is 0.55 times 1 minus 0.45 times 1. That's positive 0.10, 10 cents of edge for every dollar risked. In simple arithmetic terms, that's a money machine. Do it 1,000 times and the average outcome is clearly positive. So where does the bleed come from? It comes from the difference between how averages work and how compounding actually works. Here's the trap. Expectancy is an arithmetic average, but your account doesn't grow by adding averages. It grows by multiplying. If you risk a fixed percentage of your account each time, a win multiplies your balance up and a loss multiplies it down. And multiplication is not symmetric. Lose 10%, then gain 10%, and you're not back to even. You're down 1%. That gap is called volatility drag, and it grows with the square of your bet size. The bigger the swings, the more the drag eats. Positive expectancy can be completely devoured by drag if your bets are too large. So there's an optimal bet size and there's a breaking point. For a 55-45 strategy at even money, the growth maximizing fraction, the Kelly fraction, is exactly your edge, 10% of your account per trade. Bet 10% and your account compounds as fast as mathematically possible, but watch what happens as you push past it. The growth rate rises, peaks at 10%, then falls, and it hits zero at roughly double the Kelly fraction, around 20% per trade. At 20%, your long-run geometric growth is zero, even though you win most of your trades. Bet more than that, and your positive edge strategy has a negative growth rate. You are guaranteed over time to bleed out. Let's make that concrete. Say you have a $10,000 account. Risk 2% per trade and your 55% edge compounds smoothly. Drawdowns are mild and you survive bad stretches. Risk 10% and you grow fastest on paper, but the swings are violent. A rough month can cut your account in half. Now risk 25% per trade. You still win 55 out of every 100, but run that forward and the account grinds lower and lower. Same signals, same win rate. The only thing you changed was the size, and you converted a winner into a loser. The reason big bets are so dangerous is the recovery math. If you lose 20%, you need 25% to get back to even. Lose 50%, you need 100%. Lose 80%, you need 400% just to break even. The deeper the hole, the steeper the wall. Oversized position sizing doesn't just increase your chance of a big drawdown, it increases the chance you never climb out of it. Your strategy might be perfectly fine. Your account never recovers to prove it. And bad streaks are not rare, they're expected. With a 45% chance of losing any single trade, the odds of 5 losses in a row are about 1.8%. That sounds tiny until you realize it means a 5-loss streak shows up roughly once every 55 trades. If you trade daily, that's a few times a year, guaranteed. At 25% risk per trade, 5 straight losses cut your account by more than 76%. At 2% risk, the same streak costs you about 10%, annoying but survivable. Same streak, completely different outcome. There's a second leak most people ignore: costs. Commissions, spreads, and slippage all subtract from your edge before position sizing even enters the picture. If your real edge is 10 cents per dollar, but slippage quietly takes 3 or 4 cents on every round trip, your true expectancy is far thinner than your backtest showed. A thin edge shrinks the safe bet size dramatically. The more fragile your edge, the smaller you must size to stay on the right side of that growth threshold. So what does a disciplined trader actually do? First, they measure the real edge after costs, not the fantasy backtest. Second, they never bet full Kelly. Serious traders use a fraction, often a quarter or a half of Kelly, because real win rates drift and real markets aren't as clean as a coin flip. For most retail traders, risking 1/2 to 2% of the account per trade is the practical zone. Not because it's a magic number, but because it keeps you far below the drag threshold and lets your edge actually express itself over hundreds of trades. Notice what this means. Your edge and your survival are two separate problems. Finding a 55% strategy is the fun part. Sizing it so a normal losing streak can't end you is the part that decides whether you're still trading in 2 years. The math doesn't care how confident you feel on any single setup. It cares about the fraction you risk, repeated hundreds of times. Get the size wrong, and even a genuine edge works against you. So before your next trade, calculate the one number nobody talks about. What percentage of your account is actually on the line, and where that sits relative to your edge. If breakdowns like this help you think in probabilities instead of hype, subscribe, and we'll keep doing the math the rest of the internet skips. Trade the size that lets you survive the streaks, because staying in the game is the whole game.